From Bitcoin, blockchain or distributed ledger technology to cryptocurrencies, tokens and initial coin offerings, it seems everyone involved has something to say, but can you really trust their advice? One man's had enough of weasel words and charlatans and is ready to give you impartial, independent analysis. With digestible blockchain bites, ICO analysis and need-to-know news on cryptocurrencies, author, speaker, transparency and clarity advocate and award-winning software innovator Barry James brings you Radio ICO.
This is Barry James for ICO Radio's Blockchain Bites programme again, and today I'm back with one of the movers and shakers, the organiser of the blockchain, the ICO Masterclass, which is taking place. That's what we're here for today. But also CEO of Team Blockchain, Jonny. Welcome.
Hello, Barry. Thanks very much.
Not at all. So we chatted some time ago, but someone recently said that ICO years and blockchain years are like dog years. A lot happens. The whole field's relatively new. So let's talk a little bit about how that's developing and how it's developed. But before we do, just to give people remind them of your view and perspective on this, a little bit about your background and your story, if you would.
Yeah, sure. Okay, Barry. Well, my background is I basically set up and ran and floated an asset management business here in the UK, and did that for over 20 years. And so got involved in blockchain 2 or 3 years ago, looking at how the technology could be used and implemented within businesses, and approached the whole sort of cryptocurrency ICO thing with a huge degree of scepticism, and like many people, unfortunately, still think of blockchain, Bitcoin, Ponzi scheme, all in one mouthful. Tended to think in that sort of framework.
Yeah.
It's just easier to put it in a box, too difficult to handle.
Yeah.
And set up Team Blockchain a couple of years ago, really to help people try and understand some of the opportunities and challenges around the technology. And very quickly, we were being asked by companies to help look at their initial coin offerings, and look at some of the regulatory and the compliance and the verification and standards and things like that, and really sort of took some of the best practices from sort of the traditional asset management world and listing of companies and initial public offerings, etc., and tried to bring those into the initial coin offering world, which, to be honest with you, that wasn't a particular popular thing to do 18 months ago, because people said, don't need regulation, we're just going to raise money literally off the back of a fact paper, and to be fair, some of them did, but they've also crashed and burned. So yeah, it's interesting, your analogy with dog years. If I look back over the last couple of years, you think, why isn't things moving faster, and why can't we have a sort of regulation, and why can't all the banks just embrace all this? And it seems at one level things are moving slowly, but actually it's a little bit like the swan going across a pond. Nice and serene and sort of very happy, and underneath there's the legs are paddling along, and there's a lot of work going on behind the scenes. Yeah,
I was looking yesterday at some of the stats, and if you kind of look at the rise of this form of funding, token offerings, ICOs, I think we're having to broaden the term now, aren't we, a bit? Maybe we could talk a bit about that as well. It's really less than 2 years old. It's 18 months, 2 years. So what are the main changes you've seen in that time? Part of the frame, obviously, being, when the eponymous Satoshi came up with the original white paper, it was
10 years ago.
It was very, very separate from the world of asset management and so on. What changes have you seen in that time?
Well, I think what we've seen is that to date there's been almost a myopic focus on ICOs being used to raise money for typically start-up ventures, and it's been tremendously successful. Raised in excess of 20 billion in the last couple of years, and actually 2018 raised more money in the first 6 months than the whole of 2017. So it's been a very successful way of raising money. But I think that's very much just part of the equation. And I think what we're going to see going forward will be initial coin offerings, token generation events. They've all got these crazy names. And they'll be used, I think, as a way to attract and reward customers. So if you look at some statistics from sort of Bain Consulting, they're saying that a 5% increase in client retention can result in as much as 71% increase in profitability. If you look at someone like Gartner, they're saying...
So can I just press pause there for a second? Would you say that again?
5% increase in client retention can result in up to 71% increase in a company's profitability.
Why?
The old analogy of stop running around and being a hunter, i.e. looking for new clients, and look after your existing clients, be a farmer.
Yeah.
Because we all, in business, you're familiar with the analogy of the 80-20 rule. You get sort of 80% of the hassle from 20% of your clients, or more positively, you get actually 80% of your business from 20% of your clients.
Yeah, I've never heard that stat before. Isn't it stunning?
Yeah, no, it's incredible. Well, Gartner also came out with some figures last year saying, 80% of firms' future turnover will come from 20% of their clients. So what that's about is not necessarily looking for new clients, looking after your existing clients, encouraging them to come back, retaining and servicing those clients, and rewarding them. Now, this is nothing new. We've had, Clubcard points, we've had AML points, we've had, credit card, Avios and Nectar points for a number of years.
Because they work.
Well, they do work, and probably the most dramatic example of that was American Airlines back, a few years ago when you had the sort of, the sort of crash 10 years ago, and people stopped sort of flying for a while because they just banned sort of company travel. And people, executives had literally millions of miles, and so they said, okay, well, what I'm going to do, I'm going to travel, and I'm going to take the family, I'm going to use up my reward schemes. And of course, when they're on the plane, they have a meal, and they buy some drinks, and they buy some perfume, etc., etc., etc. And so they're actually spending money while they're there. So the reward scheme in America alone is a $300 billion market. The trouble is, majority of that is actually sitting as an intangible liability on companies' balance sheets. So the more successful the marketing department are, the worse it becomes from the finance department.
I guess you write that off after some point?
Well, it's very difficult because unless you actually cancel your scheme, unless you actually say, we're no longer going to give you a discounted travel or access to whatever it may well be. But put it in more simplistic terms, for us sort of over 40, we used to send Christmas cards, and we used to buy something called a stamp. So at the end of December, we'd end up with 40 or 50 or maybe 100 stamps, and the post office had received the income, but now it had an intangible or a very tangible liability, because at some stage those stamps are going to get used
and get delivered,
but Postman Pat, how's he going to get paid? Because postmen have been paid up front.
Yeah.
So that's a little example, and that's true of every postal system around the world. You buy stamps and then you use them up over a period of time, typically.
But this isn't just the return of air miles in a different form, is it? It's a little bit different. I was looking. There was a quote. I was looking at an article about airdrops.
Yes.
And the quote was something like, "Who knew that if you if you give people money, that they would pay attention to your brand?" But it's not quite that, is it? They don't. Giving people things free doesn't work very well anymore. Giving people free money doesn't work. They just put it in the bank account and walk away. But this works differently.
Well, I think the way marketing and the way it's all about getting your attention. It's all about keeping your attention, and therefore encouraging you to come back and spend more. For those of us that don't understand very much about the marketing and advertising industry, why would Coca-Cola spend 20-30 million on a 30-second advert during the Super Bowl? But they do. Why do Visa, Nike, and companies like that spend millions, tens of millions, sponsoring the Olympics? It's all about eyeballs. It's all about brand recognition. Now, if you're no longer watching the television, why would you advertise on a Saturday evening on the TV? They're not. They're actually doing digital advertising. And actually, the younger generation don't like adverts, but if they've got some sort of endorsement or sponsorship and name recognition, which is why we're seeing, well, look at the phenomenal success of Netflix. I can get all that content for next to nothing. Amazon about delivering books. Now I've got hundreds of films for £99 a year. How does that work? Because they're getting attention. And
pre-selling.
And they're pre-selling. They're getting their money up front, which is a great cash flow model. So what we're well, with Netflix not quite so much, because they're building a huge debt pile because they're spending the amount of money they're spending on production of films and what have you. But a good example of that was how Facebook were the company that got the National Baseball contract, not NBC or ABC in the States, because people don't tend to sit and watch TV anymore. You know, the younger generation don't actually own televisions. They don't have a TV license. They consume nearly everything on their laptop, when they want to watch it, how they want to watch it, where they want to watch it. So you've got to find and spend your marketing money to say, look, there you go, there's, instead of paying £100 for your viewing on primetime TV, I'll pay you maybe £20 worth of tokens. Now, the chances are that less than a third of people will redeem those tokens, but nevertheless, the more tokens you get, the more it's worth. And if you make those tokens easy to convert in exchange, I have them on an exchange, you can then convert your tokens into something else.
Maybe after a period of time, but if I've got 20 quid's worth of, I don't know, Mercedes tokens in my wallet and I don't, I keep looking at them. I'm either going to spend them or maybe I'm going to trade them later. It's slightly different, isn't it? But you mentioned the Mercedes coins earlier on. Tell me about those.
Well, it's interesting. Mercedes has just come out with a loyalty program called the Mercedes coin. So the more cars you buy, the more servicing you have, the more things that you do and interact with Mercedes, they're going to give you coins, and you can then trade those coins against maybe giving you access to sporting events or. Mercedes sponsor a number. It's not just motor racing. Mercedes recently sponsored the Falcons' new stadium. An amazing. I thoroughly recommend anyone to just go online and see this new $2 billion stadium. It's got the biggest TV screen in the world with a petal-shaped roof that opens up. Incredible. With I think it's a 5-year sponsorship of Mercedes-Benz. So I would imagine that in time, if you've got enough Mercedes coins, you can perhaps get a discount to go and see football with the Falcons. If you're into that, which they've got a huge fan base, and many, many people are. Now, you're not very far away then from converting a Mercedes coin in the Mercedes ecosystem into a tradable token, where you then swap your Mercedes coin for maybe a Jaguar coin, or maybe it's for a Burberry coin, or maybe it's for a McDonald's coin, or maybe you just want to cash it in. Because in the same way, if we look at perhaps a closer to home here in the UK, you have Clubcard points. And Tesco's issue the Clubcard points, and you get £10 off your groceries. Alternatively, you can go to Pizza Express and get £20 off a pizza, or you can go to Eurotunnel and actually get £40 off your cost of travelling across to France. Now, I would contend that if you put Clubcard points onto an exchange, they are not worth £10. Neither are they worth £40, but they're worth somewhere in the middle. I personally would be very happy to pay £30 for them because I go to France quite a lot. So I would take your £10, pay you £30, and then I would get £10 effectively off my travel. So once you start seeing the user experience, the ability for people to be able to use these tokens and coins, and right now all we're talking about is free tokens. So there's no KYC, no AML, no financial services involvement at all. It's simply, this is a way to bring, for your older listeners, digital green shield stamps. Air miles, nectar points, reward schemes, which have been around for a long time, and it's really bringing that into the sort of the new era, whereby it's a much easier user experience to use and be rewarded for your patronage and your loyalty with global companies.
Yeah, I for one never thought I'd see Mercedes vouchers. It would have never occurred to me to associate that with the brand, but it's a little bit different, isn't it? I for one, I'm not a big voucher fan. I always lose them anyway, but this is different, isn't it?
Yeah, well, it's different because if you've got them in a decentralised format, in a safe environment, let's be honest, an app on your phone, you're not going to lose them. And then if you're prompted, if you prompt say, well, I've got £100 worth of Mercedes coins, well, can I use that to get a discount off the service from a car or whatever like that? So it's just a way to encourage and engage with their clients on an ongoing basis.
There's all sorts of possibilities and cross promotions and good stuff people might want. So what about the Amazon coin?
Well, again, I just think it's a good example of Amazon doing a similar sort of thing. I think probably what's more interesting is what IBM are doing. Actually, here we are, sort of middle of September 2018, and there's a couple of characters called the Winklevoss twins.
Oh yeah, those the Facebook. How can I put it? Heirs, shall we say?
The rowers.
The rowers, yes.
Couple of chaps.
Ended up with quite a lot of Facebook shares, one way or another.
They've done very well, but they've been trying to sort of get a Bitcoin ETF, exchange traded fund, and at the moment the SEC have turned them down. But what they've actually achieved last night, I think, is actually really, really important for the holdings ecosystem. Yeah. Because they've actually now got a regulatory authority in New York to back them.
Probably one of the toughest places in the world.
Yep.
Think bit license.
And then they've got State Street, one of the biggest custodians in the world, to basically give the custody for a stablecoin. Now, for those who don't understand what stablecoin is, basically it's a way of tokenizing a currency. So if you buy their stablecoin,
currency meaning what most people would call real money, fiat money.
Fiat money, yeah. Well, it's make-believe money, isn't it? Because it's not.
Yeah, well, of course, it's no
quantitative easing, inflation. But we won't go there. So it's a stable coin that is backed by, in this case, it's going to be backed by the US dollar. Yeah. So for every one coin, there'll be $1, and they've put in various systems and procedures to make sure that is the actual case. Because again, this isn't a new concept. We've seen Tether for a while, and allegedly Tether have a couple of $1 billion worth of their stable coin, and it's backed by dollars, but there's some concern as to whether it is actually backed by dollars.
Yeah. Well, I know there's been, it's not a full audit, but there's been a review of that which came out very favourably and said it was, it was actually, as far as they could tell, entirely true. Yeah. And there's an audit planned for that. I was writing about this recently, but I'm going to ask the sucker question: why bother? If this coin, even though it's electronic, represents $1, why wouldn't I just use $1?
Okay, so if we look at the worldwide repatriation of money by overseas workers, last year, 2016, the World Bank said the market was approximately $600 billion in size. So these are people, typically low-paid workers, cleaners, security guards, gardeners, etc. Typically it might be Filipinos or Indians or Chinese working in so-called Western developed countries, and they're sending money back to their family and loved ones in China, India. India is actually the biggest market, with approximately $60 billion a year of dollars is being sent back to India by overseas workers. Those people are being charged up to 15% if they use so-called real money, i.e. dollars. Alternatively, you could send a stable coin for almost nothing.
Yeah.
So you're helping the poorest people in society to actually transfer money back to their loved ones. At the moment, the banks are basically taking 10 to 15% away from them. So that's at least $6 billion a year just for the Indians. Across the world, it's 60 to 90 billion of costs.
Yeah.
Because it's got to go through the banking system. It's a foreign exchange charge. How many times do you go to the airport and it says commission-free dealing, and you look at the spread between the buy and the sell price, and it could be 10, 15%.
It's not just cost, though, it's friction as well, isn't it?
There is a lot of friction costs, and it's interesting. There's a company here in London called Vora, who are actually issuing bonds using blockchain technology, and they claim that the cost of issuing a bond using the technology is 90% cheaper than traditional ways.
Wow.
So that now means that instead of bond issuance being for governments and large corporations, you could potentially see small to medium-sized businesses issuing debt, raising money via bonds, which historically they haven't been able to do because the fixed charge and the friction costs, as you refer to them, are so high. So we're seeing many new opportunities being opened up, and a lot of this has come out of the crypto space. So yes, they're important for raising money, but B, I think we're also seeing a relatively easy concept, i.e. $1 for a coin, a stable coin, being launched to save money because of the friction costs. And then we're seeing these airdrops, giving away tokens for your loyalty, which then can be traded. And the most up-to-date one of the airdrop is a Japanese social messaging company called Line. They've got 200 million members. It's a little bit like WhatsApp. And they've recently launched their Line coin, given away tokens, and then they've got it on exchange. So the more social messaging you do on that particular platform, the more tokens you'll get, and then you can exchange those tokens either for upgrades within their ecosystem, whatever that may will entail, or you can then swap them out and you can actually change those tokens for another coin in some shape or form.
Yeah, well, that's one for the chatty. Yeah. We'll do all right. Final question for you. There's been a really interesting development with Google, hasn't there? They're now indexing the Ethereum blockchain. Gosh, who saw that coming? Is this a precursor to something else?
Well, it's very interesting because in theory now, Google with their analytics package are able to sort of will be monitoring and will be actually indexing by looking at and categorising what's going on the Ethereum blockchain. So in theory, they'll be looking at various smart contracts and what's happening and what's not happening, so they can give a much richer picture of what's happening to data and information. So it's no good just looking at what's in published material, what's in the internet. Now they want to look at particular blockchains. And personally, I wouldn't be at all surprised if this is a precursor to some form of bid, some sort of closer association for Google to get involved with Ethereum. I appreciate Ethereum has some Swiss foundation. However, it would possibly be quite attractive, especially given the current price of Ethereum, for Vitalat, if he was suddenly given $1 billion worth of Google shares, and then the whole Ethereum ecosystem was somehow developed and evolved, which makes it a little bit more Google friendly, and so therefore they've kind of sort of got control of a blockchain application. Where at the moment most ICOs are launched on the Ethereum blockchain. How long would it be before perhaps we see Apple having a proper Cardano? Maybe we're going to see Amazon have a go at ESOS. So, if they can control, or if they can have influence, or if they can have perhaps just a partnership and a closer work relationship with these different types of blockchain, these data gatherers could actually have even further control and influence over our day-to-day lives.
Yeah. Just as we close off, I'd normally ask you, if we're just talking about innovation generally, how do you see 5 years, 10 years in the future? But we know we're in dog years. So how do you see things? Sort of 2 or 3 or 14 or 7 or 14 dog years in the future. In the light of a really interesting stat that you drew to my attention here, that how many was it? 31% of central banks, according to the participants in the DLA Piper survey, expect central banks to add cryptos to their balance sheets in the next 5 years. Well, there you go. That's 35 dog years, I suppose. But were there any other really interesting stats from that report, which I believe is published shortly?
Yeah, the DLA Piper have carried out a global survey. It's called Digital Transformation of Financial Services, and they were looking at payment platforms and cryptocurrencies. So rather than me pontificating what I think and what I don't think, I thought it was very interesting that, as you say, 31% of the people they interviewed thought within 5 years that crypto currencies would be held on the balance sheets of central banks. And it's, and that, when you look at, they also had something like 17% of asset managers are considering or already have a strategy to invest in cryptos. So it's very interesting.
17%.
17% already.
Now that's the only stat so far today. We're nearly at the end, as I said. That I think should be the other way round. It should be 71.
Well, yeah. Well, but it's. I think the trouble is that a lot of the regulated entities, a lot of the asset managers, a lot of the banks, they are very concerned about incurring the wrath of the regulators. And one thing it always just makes me smile, and when people say, "Oh well, cryptocurrencies, it's all about drug running and money laundering." The last thing you'd want to do if you're carrying out some sort of nefarious activity is to get involved with a cryptocurrency, because it leaves a digital footprint, which if it's on a blockchain is there forever. Yeah. So that's the last asset you want to get involved in. And the West spends something like 20 billion a year on AML and KYC onboarding procedures to try and stop sort of money flows being from sort of illegal activities, and yet the banks in the last 10 years have already been fined over $100 billion. So the so-called regulated, well-run entities that we trust and leave our monies in are consistently getting it wrong, whereas the majority of cryptocurrencies have very, very strong KYC and AML, because it's actually not that difficult to do, and it's an easy sort of tick box that they can then say, look, that isn't a problem, we know exactly where the money's come from. So I think as institutions begin to see and understand that, then that as an obstacle will be sort of kind of removed. And what we're seeing, it's quite interesting. From a regulatory point of view, people managing your money, they typically can only buy assets on a recognised, regulated exchange. So the London Stock Exchange, the S&P 500. So let's just assume, because there are a number of exchanges like the Swiss Stock Exchange, the Gibraltar Stock Exchange, the New York Stock Exchange, even NASDAQ. In the next, I think, 2 or 3 years, if not before, we will see a number of regulated exchanges trading cryptocurrencies. So then the next issue is, well, we need to have a custodian. So as someone looking after your money, as a mutual fund manager, as a pension fund manager, I need to be able to say, well, I don't hold your money, it's held by a custodian, so it's safe and secure. Well, we've seen Goldman's, we've seen Standard Chartered looking at it, we've seen Santander looking at it, we've seen now obviously State Street, all saying this is a space we're interested, we want to get involved in, and coming up with possible solutions. So the next area then you have to look at is, okay, I'm a fund manager, I'm going to go buy these assets. If I don't tell my PI insurer that actually I'm getting involved in this, I could suddenly find my PI insurance is invalid, which means I need to lose my regulatory licence. So you then got to talk to the insurance world so they understand what it is and where the money is actually coming from. And then the final challenge is the banks. Unfortunately, there's many banks that won't touch cryptos because they're concerned that they might get fined at some stage in the future. But you've got a number of banks here in London, in Europe, that are actually offering banking services for companies that want to or are involved in cryptos. So the banks are sorted out, the exchanges that's in place, there's already custodians, the insurance market, when you talk to them, explain what it is and the risk they want. We don't want to insure the value of the coin, we want to do directors and officers liability insurance, which they do by the bucket load, professional indemnity insurance. So we're now getting these building blocks, the infrastructure in place to allow the institutions to come in involved in this space. And I think that's probably the biggest change we've seen probably in the last 12 months. And we just see that gathering momentum based on the conversations that Team Blockchain are having with various different lawyers and accountants and corporate brokers and market makers. They're getting more and more of their participants want to get involved in this, but need those regulatory building blocks in place, which are being put in place behind the scenes. Hence the analogy of the swan. There's lots of stuff going on that people aren't perhaps aware of, but there's going to be some casualties. Probably one of the biggest casualties are going to be people that provide registrar service, which the average listener perhaps aren't familiar with, but every quoted company, you typically have a separate company that holds the share register. Yeah. So they know who's actually bought and sold, who's owning the company at one time. Well, that is such an easy thing to be put on the blockchain and just take out that cost. So it's all about taking out the friction costs, taking out the unnecessary costs, making it much more visible. In that particular case, then actually, do you need to have nominee names? So now can BP know exactly who are its shareholders, and maybe it does give shareholder perks, which were so popular back in the 60s and 70s, but to some extent have gone away because the quoted companies don't know who the shareholders are. All they know it's Schroders nominees. It's Aberdeen Standard Life nominees. Whereas actually underneath, who are the people that have got beneficial ownership of those shares? So actually, I think we're seeing technology coming into play, which is enabling us to go back to where we were a little while ago in terms of having a better direct relationship between the people that own the business and the people that run the business. So I think that in itself is a really exciting thing that we're seeing happening and evolving.
And greater transparency.
Greater transparency and just greater flow of information, and hopefully what that's leading to is actually, particularly in Europe, post-GDPR, the power of your data information is being held by you as opposed to being held by a third party. Because it's an interesting question which I'd like to leave you with. Everyone talks about the power and the financial might of the Facebooks, the Googles, the Apples, the Amazons of this world, because they know so much about what we're doing. They've got our data. And therefore, does that mean data is an asset? Or is it a liability? And unfortunately, in the last couple of weeks, we've seen British Airways being hacked as a well-known brand. And if you're holding data, does that represent a liability? Because if you lose it, especially with the Information Commission Officer being able to fine you 4% of your worldwide turnover, if you haven't got the systems and procedures in place, so surely that data should be held in a very, very decentralised environment, not rely on one firewall. Surely you want it to be held by, ideally, military-grade cryptography, i.e. super secure, and you don't want it to be tampered with. That's now sounding a lot like a blockchain to me. But you don't see many people valuing data on their balance sheet as an asset. But we hear of a lot of people talking about data as a liability. And one of the things, again, coming out of the DLA Piper report was some of the banks and financial services companies have now really looked at the data they're holding. Why have they got it? How have they got it? And what are they going to do with it? I hope that doesn't lead to lots more cross-selling, because I think most of us are sick to death of that. But nevertheless, I think people are saying, do we need that data? And if we don't need it, we'll hand it back.
Yeah, I think there's been a realisation, almost an apotheosis over the last, 2, 3, 4 years of the value that is in data. I don't think it's been realised historically, but
But whose value is it? If it's my data.
Now that's a whole other question, isn't
it? Yeah. So what we have seen is, unfortunately, the West Coast of America in particular, they've monetised the data. They've sold it to the advertisers. At the end of the day, all Google is doing is basically selling people's data to the advertisers.
So one of the trends I have seen, in fact, I interviewed the founder of Swoop, who are a find engine, not a search engine. You won't let me call it a search engine, but part of their innovation and their ICO is that they are going to monetize that data, unless you ask them not to. But if they monetize it, then they share it with you, and that's a real opportunity that actually we're seeing again and again. With different token offerings and ICOs. So on that, as we close. I'm sure we'll be back here in a dog year or 2 or 3. Just so we I can hold you to account somewhat on that. What are your predictions? What are your predictions going forward?
Predictions in what sense?
What do you think is going to happen? With Google, with Amazon, with any of this stuff. Where do you see us going in the next 5 dog years?
Next 5 dog years, dearie me. Well, I think that what we're going to see is there are certain companies that I think there's a very real possibility they will come under pressure to be broken up. I think the likes of Google and Facebook, I just think they've become more powerful than certain governments.
Or possibly more transparent.
Maybe or maybe not. But I think that it's very difficult for regulators. We keep seeing, Google being fined, 3 billion, 4 billion, 5 billion by the European Commission. It's kind of their price of doing business. It's kind of, we've been fined, but we can carry on business as normal. And I wonder, there's a limit to how long they can carry on. I think that the current financial markets are not operating efficiently. By that, what I mean is that if there's a way to issue bonds 90% cheaper, then I think you'll see more and more, not just small companies, but the World Bank, which is merrily issuing $70 or $60 billion a year with bonds, they'll turn to this sort of technology. And as it starts to get more and more mainstream attraction, the new asset that's been created, tokens, currencies, whatever you want to call them, I think is set to flourish against a backdrop of seeing increasing institutional interest, because you're cutting out the friction, you're cutting out the intermediaries, you're making it more transparent, you're making it more safer, and perversely you've now got an asset class which has been really the preserver of individuals, not institutions. Now the institutions want to come in and play. So I think that based on the work that's actually being done, I think we're going to see a lot more institutional interest in this field, which will have the very beneficial effect of creating more liquidity, and that will crush volatility.
So, as we close, one thing, if there's one thing you'd like people to remember or take away from this session, either in the institutional world or the asset world, what might it be?
I think the one thing is not to be afraid to ask. There's a lot of people out there that have got preconceived ideas about blockchain, about cryptocurrencies, and actually blockchain is a very powerful technology, been around for a long time. Cryptocurrencies can do all sorts of different things in different situations. Sometimes they are like a bond, sometimes they're like an equity, sometimes they're like a physical currency. So it's not just a matter of saying, cryptocurrency is just one thing. The way that currency is being used can be used in many, many different ways. And likewise, I think that we're going to see more and more global brands getting involved with cryptocurrencies via these airdrops, giving you tokens which you can then spend and use. And it's a young person's game. And the new generation of people coming through who are much, much more digitally savvy are embracing this as an ecosystem.
Yeah. So we could go on and on, but and I'm sure we will in the future, in a dog year or a few. I'll add my one prediction that you can take me to task on next time. But it seems to me that there's going to be more and more pressure and more need for this to come out of the too difficult box, not just for the younger generation, but for everyone involved in business more generally, and not just in assets and so on. But anyway, you can hold me to account on that later.
Well, but hopefully you've given some of your listeners a bone to chew on.
A bone to chew on. And so, Jonny, thank you for this session, and I look forward to talking more before too long.
Thank you.
ICO Radio was brought to you by author, speaker, transparency and clarity advocate, and award-winning software innovator Barry James. Get in touch with the programme, put yourself or someone else forward as a guest, visit iconewsdesk.com. And if you've enjoyed the show, please leave a review. And don't forget to subscribe to get your next insights and interviews from the ICO Radio podcast.